Hello, I'm Juliette Sali. In this week's edition of IG Macro Intelligence, we take a look at the economic climate in China and implications for Aussie investors. China has set a growth target for 2024 of around 5%, which many analysts say is ambitious. It is the same target as was set in 2023 and is being seen as in the upper end of what's achievable, given a raft of economic headwinds, including deflation, the troubled property sector, and a downturn in both business and consumer confidence. Chinese Premier Li has admitted achieving the target will not be easy, adding the government will assist through prudent measures and targeted fiscal policy. The International Monetary Fund predicts China will grow at a more modest 4.6% this year, declining towards 3.5% growth by 2028. James Tom from Aberdeen told Ausbiz recently that China has a tendency to overshoot its economic targets, but he remains constructive on investing in China as companies continue to deliver robust growth. China's stock market had fallen around 11% over the past year compared to gains on Wall Street's S&P 500 of around 33%, but there has been some stabilisation in the past month, with state funds or the so-called national team buying up shares since the Lunar New Year holiday, with many suggesting that perhaps we have seen a bottom. Chinese leaders have been actively trying to stem the stock market rout, which risks triggering social and economic instability. Beijing has also replaced its chief market regulator and introduced wider trading curbs in an effort to bolster confidence. And despite the challenges, most fund managers say China is too big to ignore. David Sokolsky from Carrara Capital told Ausbiz a lot of negativity has been overdone. He says while it's certainly not boom time right now, things are not as dire as what had been priced in the equity market. Well, there are a number of ways to play the China story in the ASX, including mining stocks, food companies like A2 Milk, and travel firms such as Qantas and Hello World. Let's start with A2 Milk, the company which produces and sells A1 protein-free milk and related products like infant formula, is dual listed on the ASX and New Zealand Stock Exchange. The stock is up 38% year to date, and most analysts are bullish on its outlook. The auspicious Year of the Dragon is expected to boost fertility rates in China, which marketing expert Chris Flay says could further boost sales of A2 milk products, according to the AFR. Meanwhile, shares in iron ore producer Fortescue Metals Group are down nearly 16% so far in 2024 as iron ore prices have fallen amid bulging inventories. At its recent National People's Congress, China's leaders once again indicated property is for living in, not speculative investment, sending the price of the steel-making metal lower. And most analysts are bearish on the outlook for Fortescue, which hit a record earlier this year. Then, of course, there's the travel sector. The number of Chinese tourists visiting Australia remains well down on pre-pandemic levels, with Oxford Economics signalling full recovery may not return until 2025-26. Still, package deal companies like Hello World are expected to benefit from any tourist influx. Shaw and Partners cites the removal of travel restrictions as positive for the company and has a price target of $3.80, suggesting a 35% upside from its current share price. And that is your IG Macro Intelligence for this week. We'll see you next week.